Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Ayesha Tariq, co-founder of Macro Visor, thank you so much for rejoining the Contrarian Investor Podcast today.
Great. Thank you for having me back. It's my third time. I'm very excited to be here.
Yes, very excited to have you. Third time's a charm. Not that the other two weren't charms either, but we have a lot to talk about here. And you wanted to kick things off with stagflation. I guess to preview all this, we can say that things seem to be pretty positive these days in markets. After some topsy-turvy weeks, the first 3 months of the year were good, but now as we start May, things seem to be on solid footing again. But you're not completely convinced. Is that right?
To a certain extent, yes. So I think what turned the market around was Fed Chair Powell. And he came on and he said, I don't see the stag or the deflation. And from his perspective, I understand where he's coming from, because what he's trying to say is growth is still strong in the US, which it kind of is. And he's saying inflation has come down a lot, which it actually has. But what we're trying to say here is things are starting to get sticky and going in the other way, right? So you know better than I do that when we talk about the macro, we like to talk about the rate of change. And the rate of change we're seeing in growth is slower, right? What we're seeing in inflation is higher. And now finally, we've got unemployment numbers, which is also starting to trend higher. So all three things combined, I'm not surprised that people have started talking about stagflation here, right? Are we in that situation just now? Perhaps not. But that's where everything seems to be headed. Now, you and I both know things change very quickly in the economy, sometimes very slowly, but sometimes very quickly. And in this case, we might just avoid that stagflationary scenario. But at the end of the day, we need to be careful of what is to come.
Mm-hmm. Yeah, now stagflation, of course, is the combination of inflation with lower growth. Now, inflation, this is not new. This has been going on for years. And the higher Fed rates have cut into it a little bit, but it's still higher than the Fed needs it, 3% and change, whatever, and they need it to be at 2%. But despite all this inflation and higher prices, the consumer has been able to power through and just keep on purchasing, which has propped up growth. Do you think that is due to stop or slow? Or because that's one of the things that has kept this whole thing from rolling over?
Absolutely. So consumer growth still remains strong, but we've been describing something since the beginning of the year called a K-shaped economy, right? So where the economy looks like a K, right? So we look at it like this, where we see the top 25% in the high income, consumer base, they are spending because, they've generated wealth post-pandemic. They've got enough saved up. And, with Fed rates pretty high, they're actually earning money on their cash, right? So they actually have more disposable income to spend. Now, the middle 25, or let's say 50%, they're struggling to a certain extent. And then the bottom 25% are really struggling. And you can see that in the earnings for, say, for example, Dollar General and all the other discount stores, where we thought, people would be trading down. But unfortunately, the lower income consumer has been hit really hard because you had stimulus packages taken away from them, and unfortunately, prices are still too high for the lower income consumer. You're seeing food prices still remain sticky and relatively high. So the basic necessities are still, hurting these people. Not to mention, they also have quite a bit of consumer debt, right? So we're seeing credit card interest rates go up. We're seeing personal loan interest rates go up. So these are not the asset-rich, cash-rich people who can actually earn from higher interest rates. They actually have to bear the burden of the higher interest rates, right? And therefore, what we're seeing is a dichotomy here. Let's say the top K, they're still spending and sort of boosting up consumer spending for the country as a whole. And then you have the bottom K who are actually struggling and would like to see lower rates and lower inflation, in fact.
Mm. But again, that's not necessarily new. I mean, the rich get rich, the poor get poor. That's kind of, and again, is that the type of thing that's going to impact things now of all times, do you think?
So in general, even the rich who have gotten rich, we are seeing a slowdown in spending, very gradual, but we are seeing a gradual slowdown in spending. The other part of the growth equation was obviously government spending. So government spending had propped up GDP growth quite a lot over 2023 and 2022, which is why we didn't see the kind of hit to GDP growth that we should have seen when interest rates went so high. But now we're starting to see some tempering in, government spending. Obviously, we still don't have a US government budget, and that's kind of hurting spending a little bit. We're also in an election year, so there's, again, another issue over there. And finally, we're also seeing it in the unemployment numbers, by the way. So this time, when we looked at non-farm payroll numbers, it was actually, so the government hiring, the federal government hiring was a part that was kind of propping up the non-farm payrolls. And this time, the decrease was quite a bit led by this government hiring. So government isn't hiring as much anymore, let's say. So the government spending is coming down, and that will also probably drag down growth a little bit.
And now you're seeing employment slow as well, the growth in employment.
Yes.
Talk to me about that.
Yes. So, well, one thing that everybody measures is the quits rate. That's how many people quit their jobs, right? Now, when jobs are abundant and when you know that you can get another job like this, you tend to quit your job, or you have enough in the bank, you quit your job, right? However, what we're seeing is quits rates have fallen now almost to, I want to say below pre-pandemic levels. So which means people are now afraid. They're not quitting their jobs anymore. They're sticking to where they are because they're afraid that if they quit their job, they won't find another one. The other thing that we also measure, obviously, is the JOLTS, which is the job openings. And it's still pretty high. It's at about 8.4 million, which is higher than pre-pandemic levels, which was around 7 to 8, I want to say. But if you look at the curve, it's coming down.
Mm-hmm.
It's clearly coming down. So yes, the job market, we want to say, is coming back into better balance. But in many sectors, I want to say that there is pressure of unemployment.
Mm-hmm. And, the last jobs report, the non-farms, wasn't great on that level either, although still 80,000 jobs.
That's right, 175, I think. Yeah.
Not as much as forecast, but still not terrible.
Not terrible, no. But below 200,000 is not a great level to sustain the kind of unemployment rate we've been seeing.
Yeah. And so maybe that's why the market reacted as strongly as it did on Friday.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
Is Jay Powell wrong? And it wouldn't be the first time that he's wrong, as anybody who remembers his comments about transitory inflation can tell you. Is he wrong about stagflation, that there's no stag and there's no inflation? I guess we just talked about that, but yeah.
So I think he's taking it in the literal sense, and I'm sure a lot of people feel this way as well. But the question is, where are we headed, right? So I don't know if he's right or wrong, but what he does from here is going to determine whether he makes a policy mistake or not, And I think one of the biggest things here is cutting too soon, right? So we've sort of thought that, the Fed could start cutting in July. And funnily enough, July is back on the table now. So during this time when we saw, yields increase and the market go down, everybody was pricing out a rate cut because of higher inflation. But after this last meeting and, the unemployment rate coming in lower, July is sort of coming back on the table. Now, yes, I understand that unemployment is important and controlling unemployment is very important. But at the same time, it's still at historic lows. So the Fed has sort of projected 4% as their, unemployment target for the year. So the consensus is that if unemployment goes above 4%, and we're at 3.9 right now, they'll probably start cutting. But if he does that in the face of accelerating inflation, that will obviously bring inflation back, and probably make it even entrenched. And so maybe his best bet here is maybe to hold off on rate cuts for a little while, even if unemployment is rising, and sort of, start cutting once unemployment reaches like a scary level.
Yeah, I've said all year it's been hard for him to justify cutting rates. But yet I've had people on this very program saying as recently as January that there was going to be rate cuts in March. And that was what Fed fund futures were pricing in, as a matter of fact. And but it sounds like you're saying a July rate cut will be a mistake if things continue in their current trajectory.
That's right. So as I said, when we started when we did our year ahead forecast for 2024, we said July would be the timing.
Which was conservative at the time. People were saying January and March. So yeah, you were actually pretty conservative.
That's right. Now we're thinking that July could still be, we could still be right on July, but will it be right for him to cut rates in July? I think September might be a more plausible, scenario where you kind of see give it a little bit more time. So you at least have a couple of more months before you can start thinking about that easing cycle again. So my view is they may cut in July, but September would be the better time frame to cut.
Mm-hmm. I'm curious, going back to what you said before about the spending at the top end slowing, what kind of whether it's anecdotal or any other type of evidence that you've seen of that? Just because I haven't looked at very hard, but nothing has immediately jumped out to me.
So no, you're right. It is slightly anecdotal, and you wouldn't see it in the kind of stuff that we're looking at. So, for example, if you're looking at the big tech, those are basically corporate spending, so you wouldn't really see it there. But if you're looking at consumer discretionary, you're still seeing that there is some softening in the numbers, especially in the revenue numbers. So margins have come out slightly better, and earnings, so the bottom line have come out slightly better, and that's mainly because a lot of the supply chain issues and the cost pressures have started to come down, but revenues are also coming down, unfortunately, which kind of gives you the view that there is some slowing in terms of demand.
Mm-hmm. Yeah, no question. So what does one do as an investor here? We have, the specter of stagflation not going anywhere. What do you do?
So, our view is, let's take the view by timing, right? So in the longer run, in the sense longer run, I mean like 6 months to 9 months, we still think inflation is going to play a part, and we're seeing commodity prices still going up. We think there is still upside there. And so we would look at, the reflation trade, which I've been talking about now for a while. So we like energy, we like metals. Copper is something that we really like, and I think copper is trending the right way. And that's not just because of immediate demand of industrial production, but also the secular demand. So if you believe in the AI story, if you believe in the data center story, then you know that we need more copper, we need more energy. So both of these plays, I think, have been working well, and I think they will continue to work well for a while. Mm-hmm. Precious metals is another one. So gold and silver, by the way, because silver is also something that is required for, chips and data centers. I don't know the exact engineering, but this is what my partner tells me because he's more tech focused. And then the other side, I would tell you what to avoid. So for now, I know the market is going up now, and we will always see these bouts of, but I would still be careful on small cap growth
Mm,
because I still feel that yields have room to rise, right? We're still in an inverted yield curve situation. So we are going to see a time when the yield curve will steepen out. I don't know when, but we still think yields on the long end have room to rise. And if
mm,
that happens, obviously you will see the rate sensitive sectors and you will see small cap growth as a whole start to take a hit. So just be a
mhm,
little bit careful with small caps. If you are going to invest in small caps, my view would be do your homework very, very well, right?
mhm.
So, and we do look at picks, and so if anybody wants to see what we have on our, pick list, I'm happy for them to take a look at the website.
Yeah, which is macrovisor.com, right?
That's
Okay,
right.
cool. Yeah, we'll put that all in the show notes. So when it comes to copper, a lot of the demand there is from China. And this is a
Yes.
good segue to our next topic, which is the international markets. Obviously, you being in Dubai and
Yes.
the Emirates there have a pretty good vantage point. And what do you make of China?
So I think about a couple of months ago, we said that China is sort of, inflecting over here, and that's worked out also quite well. Fortunately, the market has been going up because, the Chinese government has made some changes. However, on a secular basis, we are still worried. So for a very long-term investment basis, we're still worried about China because the kind of stimulus that we would have hoped from the government, and the kind of measures that we would have hoped from the government hasn't come in as such. But what has happened is some of the bleeding from the property market has been contained, let's say. That's one. So that's sort of giving hope to consumers that, the market is stabilizing. So we're seeing that, come into play. You know that the market always kind of front runs the economy, let's say. And so in that respect, this is what the market sentiment is telling us. And the market is going up on that sentiment that, things are slightly improving in China. But for investments, I think we need to see a lot more.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
Well, another one, which is a pretty big topic, is India, and that's
Yes.
attracted a lot of press there. What's going on there? What's your view on that?
So India, we think, is a very good long-term growth story. So we're very bullish on India in the long term. Well, elections are currently going on. We don't think there will be any upset to the elections here. And, this government, who will probably stay, they have a lot of very interesting ideas surrounding infrastructure growth, digitization, data centers, so they want to do tech led growth, which is great for the country, which is great for the people. We still need consumption to catch up there. They as well have a K-shaped economy, more so than the US, actually. And so there is some catching up to do there, but we think this catching up will happen eventually. And, I think for the long run, it's a great place to invest and, stay for a while.
Yeah, where does this all leave oil? Because one would think that if copper is going to do well, then and if you do have inflation, whether it's accompanied by stag or not, that usually is a good thing for oil.
Absolutely. So I think for oil, on a secular basis, again, we are bullish on oil. So long term, I think we need energy and we need energy from oil. There's no two ways about it. And we just don't have the substitute as yet. In the interim, there is some question as to whether OPEC will change their stance on production cuts. The truth is, most people think that they will keep the production levels very low to sort of spark higher prices. We might see some changes though for the second half, at least if not in the third quarter, then at least in the fourth quarter. And the reason for this is because Saudi Arabia has been printing, a negative GDP growth over the last 3 quarters because of, the cut in production from oil, right? So oil is a big part of their revenues, and so that's kind of hurting them. And they are actually bearing, the burden of the cuts the most. So, we might see some change in policy there. But if they change the policy, it would likely be when, demand is enough. So if we see a slowdown in global growth, we're not likely to see a policy change. But if growth starts picking up, and we're seeing that in parts of Europe, we're seeing that in China, Japan. And so if this growth continues, this trajectory continues, then we might see pressure on oil prices from the OPEC.
Makes sense. Yeah, talk to me about these other countries, the Europes and the Japans. UK, people are saying is a good value pick now.
It is.
Germany, not so
It is.
much. Yeah, where are things going?
So I kind of like Germany as well.
You do? Okay.
But yes, I do like the UK better, because when you look at it from a fundamental perspective, the UK is far more, let's say, inexpensive than the Euro area, Germany, and definitely the US, right? So there are some great companies there in the FTSE 100. And yes, I like the UK. I also think that rate cuts will probably come in August for
BOE,
the UK, which will sort of help the market even further. In terms of Japan, I think there's a slow change going on there. Obviously, we've moved now from zero or negative interest rates to zero interest rates. But these changes will be very gradual. So we're still bullish on, the market overall, but we would exercise a bit of caution over there.
in Japan.
Yes.
What's your favorite opportunity right now? Not mentioning individual stocks, which we can't do, but just in terms of sectors or even countries. Do you have a favorite?
So I think country-wise, we just spoke about them, UK and India.
Really? Okay.
Yeah. And I think sector-wise, energy is still one of my favorites. And I also like industrials a lot, because I know there are some slowdowns there, and we are seeing some trouble in industrials. But overall, I think manufacturing will come back quite soon.
All right. So not entirely pessimistic, little optimism there, but yes, the specter of stagflation, it's still there, even if Jay Powell says it isn't. Is there anything up? Like, what type? I like to ask this of people, like nightmare scenarios that keep you up at night. Maybe proverbially rather than literally. I hope. But what are some concerns that you have here? Because, like I said, I mean, yeah, the stagflation stuff, not really new, and it seems like things are kind of okay. I mean, for the most part. So, I guess another flare up in the Middle East, notwithstanding, but there too, the markets just shrugged it off. So, yeah.
Yeah, so rising geopolitical tensions definitely is one. But the other thing is as well fiscal debt. I mean,
Right.
I recently posted this fiscal debt chart for various governments around the world. Someone asked me about Japan and China as well. I mean, all these countries are running at fiscal debt, like extremely high, government debt, and the US as well. And so, it become the way the balance sheets have inflated for these countries post the pandemic. It still remains quite scary, and there's still a lot of running off to do. So even the Fed's balance sheet, for example, now they're tapering quantitative tightening. This, by the way, should be helpful for the market. But at the end of the day, this slowdown in the, tapering, I don't think it's the best decision right at this moment, because yes, even though it's good for stocks, the balance sheet still remains humongous, and that needs to be controlled.
Yeah. The last guest we had, maybe it was the one before, I asked him point blank when he thought how much longer the U.S. had, and he said 5 years, until there's a real, kind of reckoning with our fiscal debt here.
It's about 2029, 2030.
Around then, I guess. Yeah. That was what he put as a maximum range.
Okay.
Yeah. All right, Ayesha, in closing, maybe you could tell our listeners how they can find out more about you, Yeah. So tell us about Macro Visors and what you're doing there, and how
Sure.
people can get more about you.
Sure. So Macro Visor basically, as the name suggests, it's based on, macro themes. So what we look at is obviously global macro trends, and we look at the world. We've talked a little bit about various countries. We have a nice little dashboard where we look at these countries and these asset classes on a weekly basis, as well as a quarterly basis. We put out our outlooks on a quarterly basis as well. And then we look at various themes. So a recent theme that I looked at was senior housing in the US. And I had one stock pick on how to play that as well. So we look at thematic investments. That's quite interesting. And of course, we have stock picks or ETF picks to play from these themes.
Right, and those are all behind the paywall. Yeah, and then
The
Trader Aid
picks
is.
are, but
Mhm.
the research is not necessarily behind the paywall.
Oh, okay, cool. And then Trader Aid, I love that name.
Yeah.
TraderAid.com. Uh, that is how does that factor into the whole thing? Oh,
So
that's a
trade,
yeah,
yeah, Trader Aid is more for the retail investor, and we have more engaged investors, let's say. We don't do a lot of research, but it's more based on trading. So we look at swing trading, we look at intraday trading as well, and we have some long-term investment picks, which we get from Macrovisor, in fact. So it's kind of like a mix between all of them.
very cool. Awesome. Okay, I will put all that information in the show notes as well as Ayesha's socials on the various social media channels. And that will be it for today. Thank you again to Ayesha for coming on. Thank you all for listening. And we will see you back here again in a couple of weeks. Speak then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.